What's going on, dividend chasers? It's the Dividend Bloodhound here with another investing episode. So in this episode, what we're going to talk about is what actually is a stock or a share in a company. If you like what you see in this video, please hit the subscribe button. If you've been here before, hit the like button if you like what you see in the video. Any feedback, smash that in the comment section. And if you subscribe me and I haven't subscribed you back, please let me know in the comment section and we'll grow our channels together. Right, back to the video. So, a stock is an equity investment that represents a part ownership in the company that you own the share in. It is typically recorded electronically through potentially the app that you'll be on a computer with the stock exchange and with your broker as well. But for you, it'll be on your app. So for me, I use the free trade app or Trading 212, so I can see my share or my certificate on my mobile phone. The actual sheet version will be held in paper form by your broker and in your file. So stocks are traded. They are parts of companies that are traded nearly every single working day, except weekends and bank holidays and Christmas holidays, etc., on a stock market such as the New York Stock Exchange in America, the London Stock Exchange in the UK, obviously, the Frankfurt Stock Exchange in Germany, and so on. All the world's major economies have a stock exchange, and quite large ones at that, where an awful lot of money is hauled up and invested. So stock prices rise and fall based on the supply and demand principle. So there's only a finite number of them out there. If a stock is really popular because the company is doing really well, then there's less of it out there, so therefore the price goes up. If this company is doing not so well, guess what? The price comes down. Simple as that. So the art to this is, the art to buying a good stock is spotting the potential in a company that is undervalued, and so over time you would assume that the stock price will go up as the company does better over time. It takes some research to find this out. However, there are some companies out there that are so big now that have been paying dividends for a very long time that they are naturally encourage people in without even really trying, such as we'll go with Coca-Cola or AT&T, like well-known companies that have been trading for a very long time, and everybody knows that you can buy shares in them and they'll typically be okay. So you would typically buy stock because you want for it to grow over the long term. You would never really buy a stock that's going to depreciate in value. You would always hope that it's going to grow over time. Some have higher potential than others, but your ideal situation is that stock in 5 years' time is worth a lot more than it is now. It might only be worth 20% more, it might be worth double, it might be 100%, it might even be 1,000%. It's really hard to know sometimes. So all your stocks, as long as you've not taken out a loan to buy them in the first place, all your stocks, all your sheets, the dividend paying ones, the growth ones, all of them are an asset. They are yours. They will give you financial benefit now, whether you get an income from them or you own them, or when you sell them in the future, that is going to be economic benefit. If you're unsure of the difference between an asset and a liability, please check out a previous video below in the links below, and I explain in that video exactly what that is. So there are some different types of stocks out there. So you've got a stock such as Tesla, which is a high growth, high potential stock, and it also doesn't pay a dividend, so all its money is reinvested back into making that stock grow and appreciate over time. And that's the way it rewards its shareholders, is the appreciation in its share growth over time. So you can also get high dividend stocks or dividends stock payers that have been paying for a very long time. These are called dividend aristocrats and dividend kings. So dividend kings have been paying a rise in dividend for 50 years and aristocrats 25 years. Normal dividend paying stocks that are anywhere in between that and are typically like normal companies that reward their customers for giving them reward their shareholders with a proportion of their profits for holding a share in the company. And last but not least, you have defensive stocks. So these are what some investors would argue are recession-proof stocks. So these would be stocks that aren't going to be that affected by a global recession or a crisis such as the coronavirus or whatever. They are no investment is without risk, but they are safer because they just do what they do. So they're like consumer goods, things that people can't really live without. So utilities, toothpaste, petrol for the car because the car won't go anywhere, water, that sort of thing. The companies that are slightly less able to deal with it are like Starbucks or luxury brands, so to speak. Things that when people tighten their belt because they haven't got money in a recession, their £5 or $5 cup of coffee or the designer bag is going to go out the window, and you're just going to concentrate on getting to work in your car, having gas, electric and water to your home, the finances to do so, your bank, and then feeding yourself basically. Them are the main things. Next we have, so sometimes companies do a IPO. Well, they do an IPO once and then they remain listed forever essentially. So companies like this are companies that have made it to a certain level and they really need extra money to take their business to the very next level. To do this, they will consult on doing an IPO, which is an initial public offering. So this is when they will sit down and they will set up exactly how many shares in the company that they want to sell, and ultimately the owner, whoever that was or is, how many shares they want to own first, and then how many will be sold to the general public, i.e. you and me. And then the business will be evaluated and a recommended stock price will be confirmed and then added eventually to a stock market. Now, IPOs can be very lucrative or you can get absolutely smashed at the same time. Sometimes you can jump in and the stock price will absolutely rocket, and then that's your cue to, it depends really. If you think that it will stay that way, then by all means stay, but a lot of people, once it's cleared a certain amount, they bail out basically, and then the price can drop back down to like what would be like a fluctuate a little bit and then back to a normal level. Now sometimes the complete opposite happens. You buy in at that level and the stock price goes right through the floor and you've just lost a hell of a lot of money, and then it's going to take some time for it to get back to that. And some real large amounts of money made on IPOs, and equally on the opposite side of the coin, a lot of money lost. A good one to look at that was Virgin Galactic. So when that came out, its price went up and down all over the shop, and then it went down quite a bit, and now it's just on its way back up now. I mean, it's gone up. I've been watching it. I'm not an investor in it, but I've been watching it go from $9 to $10 a share. It's now up at like $16 a share last time I looked. So it's getting back up, but I think its initial offering was about that point or slightly higher. So it's taken, if them people bought in at that price, it's taken them a long time to wait for that money to come back. The next thing we've got is a stock split. So companies can do what you call a stock split. It's up to them how much they do. So they've got a finite amount of shares. So they've got 1 million shares, and then they want to make that into 2 million. So they do a 2-to-1 stock split. They'll do this for many reasons, really. One is to raise extra capital and extra funding because they've got something they really need to plough money into and invest in straight away. Or the other option is the share price has just got their value has increased so much that they need to make it cheaper and therefore more attractive to more investors. So a lot of people will, like, a good example for you is Alphabet, Google's company, Google's parent company, or Amazon. where the share price is like $1,600 a share. Like, not many people can afford that, so you would think that they would potentially split that down to make that affordable to more people. They haven't done that, and obviously they have their reasons for that. I'm not going to go there as to why, but yeah, in the reading that I did, companies like to keep their shares affordable to most people because it attracts more people to the market, even though eventually they might own £2,000 or $2,000 worth of the share, or they might buy it all at once. It just gives them that flexibility to move around. Now, what I will say is trading 212 and free trade, they do fractional shares now, so you can buy only a segment of an Amazon share. So you can buy just 10% of an Amazon share, so you can just spend $160 on a share, on part of a share, instead of doing that. So that sort of alleviates that problem a little bit, I would say. But it's still something to bear in mind that companies do split their stock every now and again. And sometimes it is very beneficial to you, because as a shareholder, if the company does a 2-to-1 stock split, you get two shares for the one share that you had. And the problem is the value of those two shares, because sometimes it spooks investors and everybody flies off and the share price plummets through the floor. So what was a nice $80 share then got split in two, so they were worth $40 each, but then all the investors scarpered because they thought something was up. And now you've got two shares, great, but they're only worth $20 each, so you've only got $40 left over. But over time, that share price should creep back up. It does take a lot of time. If you look back over some of the big companies that have done stock splits over the years, I'm just going to name one off the top of my head now, which is Monster, the big energy drink company with the big green claw marks down the can. That hasn't been around all that long, but it has split its stock numerous times now. And I read in an article somewhere that if you had invested, don't quote me on this because it might not be completely accurate, but I think it was either $1,000 or $10,000. If you'd invested that at the very start of their company, which wasn't that long ago, only about 20 years ago, if that, if you'd invested it then, it would now be worth a absolutely ridiculous amount of money. I'm sure, because it's split and it was, you had 10 shares for your $1,000 or $10,000, whatever it was. And because it's split down and the value's re-increased each time and then it's split down again, essentially what's happened is you've amassed a whole shed ton of shares without actually doing anything. All you've done is kept hold of the ones that you had, but each time it's been split from 5 into 10 or 10 into 20 and so on and so on. But the value's crept back up to where it originally was. So instead of just owning £10,000 worth now, it's doubled, and then it's doubled again, and then it's doubled again, and then it's just gone astronomical, really. I'm sure in them articles, I'm sure if you read into it, you'll find that group of shares for $1,000 is now worth over $100,000, or it might even be millions. I'm absolutely pretty sure about the success of it. I'm just unsure of the figures, and I am sorry about that. So yeah, right down at the very bottom here we have things that can affect the share price. So there's all sorts, a whole multitude of reasons out there that will affect the share price. I mean, just naming a couple today, coronavirus will affect the share prices across the world, as it has. It's knocked a considerable amount off the stock market. For example, Boeing with its 737 MAX issues, and the grounding of its aircraft, that sent their share price flying. Tesla with all its success and fulfilling orders finally and getting that thing, that sent its share price flying upwards. So good news stories, bad news stories, the economics of it will affect your share price. Even a change in government can affect the share price. So going back 6 months or so now, or however long it was when the general election was in the UK, investors were really edgy about a potential Jeremy Corbyn Labour-led government. So everybody sort of held back and waited to see what the general election was. And then as soon as the result was announced, the very next day there was like a massive increase in share prices across the board. It was like people were referring to it as the Boris bounce, because nearly every share price on the London Stock Exchange went up by 10%, easily 10%. Sometimes, in some cases, up to 20%. It was mad to see, and it really taught me a lesson. Then other things, so some of them are outside the company's control. A change in government, company can do nothing about that. They just have to amend their business plan to whatever the new government does. But things that they can do something about is their revenue and earnings growth. And you'll see that a lot of investors sit around and wait for earnings calls from all the big companies out there. So at the time of this video, Boeing is due to do its earnings call shortly. So is Tesla. And if you were to sit back and watch the share price, as soon as the announcement comes out about what they've actually earned or what their revenue is, that will fluctuate the share price. It will either go up or it'll come down based on essentially how the company has done in that quarter. And that some people edge on that, and day traders, especially day traders, they trade in that little window where there's a big uptick and then it levels back out, or a down tick, they short it out and then they get a down tick. So I'm throwing a lot of information at you here. I mean, you probably just came here thinking, hey, it's just a share, it's just a part of a company, isn't it? But it's a whole lot more than that. And you can do your own. You need to do your own research when you're buying a stock, because there's a whole lot of information out there, and it's all really good. That you can't really do enough. I can't emphasise that enough. You can't do enough research into your stocks, really. So what I would recommend that you go and do is you look into the websites. Google is okay, of course. It is just googling whatever stock you want and what its dividend yields is, what its EPS is, what its payout ratio is, etc. You can do that way. But if you go to a company like a website like Simply Wall Street or Market Watch or Seeking Alpha, for example, you can see all this information there in one go. You just go on the website, you can see a whole plethora of information about the whole market, American stocks, British stocks, wherever you are invested in your portfolio. And then you can actually type in the individual company by its actual name or its ticker logo, and you can get all its information up, its balance sheet, its income statement, all the news articles that this company's had go on about it in the last month or so, what its dividend yield is, what its dividend payout is, how long it's been paying dividends. There is so much on these websites, and I would really recommend finding one that you like, that you get to know. My personal favourite is Seeking Alpha or Simply Wall Street, but there are many out there, and I would encourage you to absolutely get on one of these to do your research into your stocks. So yeah, in a roundabout circle, back to the start, stock, part of a company that you own. The price goes up and down depending on supply and demand. Economics can affect the share price from outside the company's control. Other things from inside the company's control, such as revenue, can affect them. There is stock splits. You can split your stock up. The stock can be split over time, and you can end up massively wealthy that way. There are different types of stocks: growth, dividend paying, or defensive. And then last but not least, we've got IPOs, which is when a company goes public for the very first time. And that's going to be me for this video. I'm going to wrap it up there. Thanks for watching. Please hit the subscribe button if you can, and I'll see you around in the next video. See you later.